Thank you, everybody, for coming. My name's Alex Thomas. I'm a senior research manager on the macro team at John Burns Research and Consulting. I'm excited to walk you through the results of our most recent Fear and Greed webinar, or our most recent Fear and Greed survey, which we do in partnership with CRE Daily, as well as our partners at InvestNext, who are able to get us a really great and unique sample to help us understand all the different trends across the different sectors of commercial real estate that we cover. My email and my contact information is all down below, and it'll be reproduced at the end as well. So feel free to reach out to me if you got questions or want to follow up after this. I'm more than happy to chat over email or over a call. Either way, just feel free to reach out. We always encourage it. We want to learn from you guys as well. So go ahead and get started here. A little about John Burns. If you've never heard of us before, if you're unfamiliar with our firm, a little bit about how we work. So this is a pie chart really of our client types, of all the different people that we're talking to on a day-to-day basis. So we've got a pretty diverse client mix all across the country. We focus a bit more on the residential side, especially on the for sale side, but we do have a big rental component of our business as well. That's apartments, that's build to rent, that's single family rental. And then we also do a little bit of work on the commercial real estate side as well. We also are really at the intersection of all the different players in the commercial or in the real estate industry. So that's the land developer side of things, that's investors, that's private equity, that's services, that's lenders as well. We can sit at this really interesting cross section that I think allows us to have some really great conversations. So the way that we look at research, just a little bit about how kind of our framework around things. We start at the top down. So we have, I sit on our macro team, so I do a lot of the top down work. I sit very much at the national level, looking at the US economy, the US housing market, real estate market more broadly, synthesizing all the trends that we're seeing come through in the data and the commentary that's out there and the sentiment data, and using that to inform our view of what we think is going to happen for the industry in the next year, the next 2 years, next 3, next 4 years. So that's really the top-down approach. We also have a big demographics team as well that provides a lot of the underlying support, a lot of the underlying framework for how we're thinking about demand, supply, and affordability over the next several years. We also have a bottoms-up approach as well. So I sit on the research side of our firm. We're John Burns Research and Consulting. About half of our business is the consulting side. So we've got consultants all across the country in all the major markets across the country. And they're on the ground. They're our boots on the ground team, talking with builders, talking with developers, with lenders, with agents. They're really out there every day having some of those conversations, doing feasibility work, talking with developers, talking with builders, and getting that kind of on the ground insight that tends to not come through, at least come through with a bit more of a lag in some of the data that we get. So that's really a big advantage that we have over just a pure kind of data research firm. In addition, we also have a number of proprietary surveys that we do. So in addition to the Fear and Greed survey that I'll walk you through in a little bit here, we do a ton of different surveys of players all across the housing industry, including builders, including real estate agents, land developers. We'll do surveys of fix and flippers as well, and then also, of course, commercial real estate investors as well. The reason that we do this is we find that qualitative data that we get tends to lead a lot of the quantitative data that comes through and a lot of the other different work that we do. So we've put a really big emphasis on some of the survey work that we do to help inform our view of the next several years. Then the last big component of our firm, we do also have client conferences. We'll do reports and white papers as well as we see a need to take a deep dive into an issue. Typically, our conferences are client-exclusive events, but we are going to open one to prospective clients, to the public, which I'll walk through at the very, very end. So stick around for an invite to one of those. A little bit more about JBREC here. I'm not going to go through all of these in detail, but I talked about the surveys that we do. This is just a sample of the B2B surveys that we have, big list of all the groups that we're talking to on a monthly or quarterly basis and surveying. We do also B2C surveys as well, so surveys of tenants, surveys of consumers, survey of developers as well. We also pay attention very, very closely to all the major industry players across real estate. We're listening to earnings calls. We're summarizing the commentary that's publicly available from all the major players, building products, apartment REITs, single-family rental REITs, public builders as well, and a few other firms as well, all across the real estate industry. We also have a massive database as well that's all quality controlled. Our clients have access to all of this data. We're not a data provider. We really focus on the analysis, but as you kind of need custom data to inform the work that you do, there are some customized exports that we're able to provide that really add a lot of value and help you look at the industry in a few different ways. The bread and butter of our work is really the insights and forecasts and reports that we do. So we start at the metro level, we have regional coverage, we have national coverage. We also have detailed sector level coverage, including on rental communities. So that's apartments and dedicated build to rent communities as well. And then I already mentioned a little bit about our client conferences as well. We meet at least twice a year with our clients, and we'll have virtual in person, and we'll have virtual events periodically throughout the year. So that's a little bit about John Burns. With that background, I want to walk through some of the meat of the presentation here, which is the Fear and Greed survey results. This is a survey that we do in partnership with CRE Daily, free newsletter to your inbox every single day. We also have our sponsors at InvestNext, who are graciously helping us get some of the sample as well. We reach out to a ton of real estate investors every single month on the commercial side to get a qualitative view of what's going on in the market that I think leads, there's a lot of great data on commercial real estate, but it's a lot of hard data, not as much on the sentiment. We really find that the sentiment leads a lot of the quantitative data that we get. It's a little bit about the survey here. The goal of the survey, which we've now been running for about a year and a half, is really to get a timely indicator of commercial real estate investor sentiment, as well as their expectations. We put a lot of emphasis on looking at expectations over the next 6 months, because again, we find that tends to lead some of the more current data that we have. We typically get between 500 and 1,000 market ratings from investors all across the country, so really comprehensive sample. That allows us to dig deep into some of the sector level details as well. For the most recent survey, our survey period was late May here into early June, so responses are timely. We typically publish this about a week or two after the survey closes, so we try our best to get that out as soon as possible, go through the insights, clean up all the commentary, and get that out as soon as we possibly can. The survey really covers 4 main sectors. So we look at multifamily, we look at industrial, retail, and office space. And like I said, our sample allows us to dig deep into some of the insights that we're able to find through our sector level coverage. And we really survey a pretty diverse group. Our audience, our participants for the survey really run the gamut between owners, operators, GPs, LPs, brokers, and a few that don't fit neatly into any of these categories, but really input from all across commercial real estate players that we think gives us some really great insight into how things are shaping up in the market. Our sample is also pretty geographically diverse as well. You can see the breakdown over there. We got investors all across the country. We also skew a bit more towards larger investors, so more institutional. We define a large investor as any owner or operator who operates more than 100,000 square feet or 151 or more units on the multifamily side. So skews towards those more institutional players. Walking through the index, our overall index this quarter is at 56 out of 100. Now, what does that mean, right? Our overall fear and greed index at 56 is on a scale of 0 to 100, where 0 represents total fear. That means that all investors in our survey are decreasing their exposure to commercial real estate. And then there's 100, which represents total greed. 100% of investors are increasing their exposure to commercial. In our view, a healthy market is probably in this kind of 70 to 90 range, right? You don't want to be above 90. That's where you start getting into irrational exuberance, right? You don't want to get too low because that's in the fearful stage. And 50 means an equal number of investors are increasing and decreasing their exposure, which in our view is a stagnant market, right? You're not seeing a lot of growth. We're just barely above that stagnant level right now, which I think as you talk to the commercial real estate investors, they'll echo a lot of the sentiment. Now, how do we derive the index? There's really 3 main indicators that we look at when we're deriving this overall survey. We look at investors' current investment strategy. So we ask very simply, are you increasing, holding, or decreasing your exposure to a particular sector this quarter versus last quarter? Then we also ask about expectations. As I mentioned, we put a lot of emphasis on asking about near-term outlook. So we ask, do you expect to increase, hold, or decrease your exposure over the next 6 months? And then lastly, we run a lot of these indices, and they tend to follow a similar format here. And we always want to look at measures of transaction volume, of velocity in the market. And our way to proxy for that in the commercial real estate space is asking about access to capital. So is access to capital easier, about the same, or harder to access than the prior quarter? That gives us a good insight into trends and transaction volumes. The big takeaway from this survey, I think, was really in that first component. We see 71% of commercial real estate investors told us that they're holding tight in second quarter of 2025. That's the highest in our survey's history. So look at that gray bar. And we've been running this for about a year and a half now. And that hit the highest level that we've seen so far. 71% of investors saying that they're neither increasing nor decreasing their exposure. The good news is that you see only about 8% say that they're decreasing their exposure to commercial real estate. Do you see more investors saying that they're increasing their exposure? But still, the overwhelming majority kind of in that wait and see mode. The other thing that's great, we do this in our fear and greed survey. We also do this in all the other survey work that we do. At the very end of our survey, we leave just an open-ended comment box. We say, hey, is there anything else we should know about the space in your opinion? No leading questions, no nothing. We just ask for raw commentary. And the uncertainty factor came through really, really clearly in this month's results, I think. I'm not going to read through all of this, but you can see all the bold there is where I've highlighted all the investors talking about uncertainty leading to slower transaction volumes, less inclination to really extend their exposure to commercial real estate right now. And that was pretty true across sectors as well. And diving into some of the sector trends, what's really interesting here is that we've seen a pretty consistent share of CRE investors increasing their exposure in each sector across multifamily, retail, and office over the last several quarters. You do see a slight uptick in most of these sectors over time as I think we get a little bit more clarity. There's some adjustment to rates potentially. But I think the big standout on this chart is the industrial investor, right? And so what you see is that, fourth quarter of last year, you saw this big spike in the share of industrial investors. That's that blue line there, saying that they're thinking about increasing their exposure, or that they were increasing their exposure over this last quarter. I think a lot of that was tied to some of the timing of the survey. This was near the election. A lot of promises were being made regarding, increasing domestic manufacturing capacity, some protectionist policies, and I think that led to some of the optimism in the industrial space. As some of the scale and some of the speed of these changes get rolled out, I do think you're seeing some of this uncertainty come to fruition in the industrial space. I do think you're seeing a bit of a pullback there, and you've seen that steadily over the last 2 quarters here, down from 35% saying that they're increasing their exposure down to about 21% in the industrial space. So an interesting reversal in that industrial space that I'll walk through in a little bit more detail. One of the great things about our surveys as well is in addition to those kind of recurring questions that we ask, we're able to tuck in these quarterly questions that are, topical, that are really what allow us to create data that doesn't exist anywhere else. So one of the things that we asked this last quarter is we asked, given all the talk about different trade policies, protectionism, tariffs, bringing back U.S. manufacturing, we asked industrial investors, all right, how long until we see meaningful impacts from some of these on U.S. industrial real estate markets? And what I think was really interesting here is I think that this backs up some of the story I was talking about a moment ago, where you don't see industrial investors calling for a big boon over the next 6 months or even over the next year in the kind of short to medium term here. They, for the most part, think that we're going to see the most significant impacts from some of these policies over the next 3 to 5 years, very likely, or even longer. The majority saying that we're not expecting to see any meaningful impact over the next at least 18 months. Now, we also asked all real estate investors here, or all commercial real estate investors, how do you think tariffs and trade policy changes are going to impact commercial real estate investment in the near term? And we saw it, again, this uncertainty coming through. About 56% of investors saying that they expect a moderate negative or a strong negative impact from some of these new policies on commercial real estate investment in their sector. And that held true really across sectors. And in all four of the major sectors that we look at, over 50% of investors said that they're planning or that they expect changes to U.S. trade policy to negatively impact their sector over the next 12 months. And what I think is interesting here is looking at the sector level data, you see that retail bar, that orange bar standing out just a little bit. And some of the commentary, I think we got some hints as to why retail investors, at least in our survey, are the most worried about trade policies relative to some of these other sectors. The commentary that we've gotten says that tariffs are likely to complicate supply chains in the near term and may raise prices for goods made outside of the U.S. And I think that translates to the potential risk for downward pressure on valuations, especially in brick and mortar stores across the country. Beyond that, a little bit more indirect, There's also just the fact that near-term uncertainty is going to likely weigh on consumer retail spending at brick and mortar stores going forward here. And I think we're seeing that in some of the data already. Just for a moment, I'm going to zoom out from our survey just a little bit. I work on our macro team, so I'm going to bring in a couple macro data points here to help support some of our arguments here. I think you already see that tariff concerns and just general and macro uncertainty are weighing on consumer and business decisions. So this is the monthly change in U.S. retail sales. We just got 2 months of negative print. So this is a contraction in U.S. retail sales and in consumer spending, essentially, which is pretty unusual, especially at this time of year. So I do think that we're already starting to see hints of this going forward. You saw a big pull forward, I think, in March, that big blue bar, also as a result of some of the expectations of changes in trade policy going forward. And then this is actually a different survey, but this is the commentary section from the ISM manufacturing survey. So every month, ISM will survey a bunch of different manufacturing groups out there. And I'm not going to read through every comment here, but everywhere you see a yellow highlight, that's where a manufacturer is commenting on the negative impact of different trade policies on uncertainty, on capital expenditure, on hiring, et cetera, towards their business. And I've been tracking the survey for a while. It's pretty rare to see the list of commentary be so uniform in focusing on one particular theme here. One of the other things our survey focuses on is asset values as well. So we look at the change in asset values by sector here. This is all to the same scale. So you can see the big green bars for office down there. Some structural headwinds to office, I think, returning to or the shift to more hybrid work over time. You've seen office valuations recover a bit from where they were about a year and a half ago, down from about negative 31% valuation drop year over year to just negative 10% right now. But what's really interesting here is some of the differences between some of the differences within sectors. So we don't get quite this granular in the survey, but one of the commentary pieces that's come through pretty clearly in our survey is that there's very different implications for valuations depending on the class of office right now. So we've noted is a flight to quality. Investors note that Class A properties are holding up for the most part better than Class B and C properties. They're maybe a little bit more on the suburban fringes, not as near to amenities, et cetera. So just note that within that number, there's considerable variation. You're seeing steady recovery in all the different commercial real estate sectors as well. So I think that's a positive sign as well. Now, again, we ask about expectations as well. A little bit more on the negative side here. We'll ask, how do you think asset values are going to change in your sector over the next 6 months? We saw that investors in all four of the major asset classes here lowered their expectations for asset value growth over the next 6 months. So really over here, back in second quarter of 2024, you saw this big uptick, and I think investors were becoming more bullish on valuations. That's really when the Fed started cutting rates. You saw the secured overnight financing rate, or SOFR, drop between 50 and 100 basis points, led to a little bit of improvement on the financing side for commercial real estate, I think. Then you started to see the Fed kind of shift their language, focus more on, well, higher for longer, looking at, maybe there's some concerns about inflation regarding different trade policies coming through the pipeline. And so you see the Fed really, just in their meeting just last week or 2 weeks ago, whatever it was, you started to see the shift to this language, or the continued shift to this language of, we're going to keep rates higher for longer, await for more clarity regarding inflation in the labor market going forward. And I think that's led to this downtick in investor sentiment we see from the first quarter to the second quarter of this year. I think that's a lot, for the most part, driven by that higher for longer regime that the investors are expecting at this point. Another potential headwind to valuations, I think, as we're looking forward, is foreign investors, right? One of the big questions that we had going into the survey was, all right, how is foreign capital reacting to some of the changes in the US right now, to market shifts? And so we asked investors, how do you believe foreign investors are changing their appetite for US CRE investments today? And you can see about a little over half of participants in our survey said that they believe that foreign investors were shrinking their exposure to US commercial real estate. Now, it's not going to impact valuations everywhere, but especially in these gateway markets where you do see more international capital, more foreign investment, I do think that has an outsized risk in some of these markets here. Looking forward again, some good news here. Most commercial real estate investors are cautiously optimistic. So we ask, Do you expect to increase your investment exposure, hold it, or decrease it over the next 6 months? And you do see pretty consistently about 40% of investors say that they're planning to increase their exposure over the next 6 months. That's compared to just about 10% or so say they're planning to decrease exposure. So I think you do see some optimism. That's encouraging from my standpoint. And I think you see that reflected in some of the continued improvement we've seen on the valuation side. That being said, I think the big barrier to achieving those expectations is this access to capital component. So we ask, how has access to capital changed this quarter versus last quarter? We also have an option for those who don't use outside capital. Now, the good news on this chart is you see that red component shrinking. The share is saying that capital is getting harder to access today, has been progressively shrinking over the course of our survey here, including over this most recent survey period. The bad news is that that green component isn't increasing. That's the share who's saying it's easier to access capital. This is where you get into the kind of stagnation of the market that I was talking about a bit earlier. About 46% saying that it's similar, unchanged today. The share of investors who aren't using outside capital is now about 1 in every 5, according to our survey, which has steadily ticked up over time here. I think that's really the big barrier to commercial going forward. Now, I want to take a little bit of time here to dive into the multifamily side of things a bit really quick. So this is the same chart that I showed earlier. This is the share of commercial real estate investors increasing their exposure in each sector. You can see that now multifamily is the favored sector, with 27% of investors saying that they're increasing their exposure to the sector over the last quarter here. And I think there's some fundamental reasons as to why that I want to walk through in a little bit of detail and highlight a little bit of our research as well on the JBREC side. I think one of the biggest fundamentals driving some of that growth and or that optimism around multifamily is affordability, or the lack of affordability on the for sale side, to be specific. This is a chart that we have in all of our rental research and our rental communities analysis and forecast. We also forecast this out over the next 4 years as well. But really, what this is looking at is the cost of purchasing an entry level home, so something that somebody going from an apartment to a home would buy, versus renting an apartment. What we see is that it's about twice as expensive to own a home right now on a monthly basis versus renting an apartment. And that includes things like taxes, property insurance, maintenance as well. All of that adds to the cost of that mortgage payment. And I think really makes that calculation pretty jarring for somebody looking to go from an apartment to a home right now. So I think that's supporting some of the strength that we've seen in the multifamily side over time here. We also expect this dynamic to continue, right? We don't expect to see significant relief in mortgage rates. We saw some Fed rate cuts. Even if we get the Fed to cut a little bit more this year, we didn't see a comparable improvement in mortgage rates. And I think we're probably going to expect that trend to continue going forward here. And that's going to drive outsized demand for rentals. As that monthly cost to own rises, you also see this reflected in the turnover data. So you've seen turnover dropping quickly, or the inverse is that retention is quite strong right now. You're seeing a lot of renters opting to renew their leases. That turnover rates declined from about 50% to about 40% today over the last 5 years. It's a pretty dramatic deceleration. That, as I said, that rent to own affordability has come through really clearly. Another thing that we do is we track the earnings calls of all the publicly traded apartment REITs out there. And I'm not going to read through all of these, but this is everywhere you see the yellow highlight is a different apartment REIT talking about how they're seeing this trend, this lack of affordability on the for sale side, translating into net benefits for retention on their side. So clearly coming through across the industry right now. The other good news for multifamily, I think, is that we've seen apartment supply hit this peak, right? We saw a lot of construction happening in 2022, 2023. That translated into outsized deliveries in 2024. This wasn't every market. This is a lot of markets, especially across the Sun Belt. But the good news is, I think over the last couple of quarters, what we've seen is that we're essentially at peak apartment completions, or we're a little bit past the peak at this point. So you saw completions start to fall over this last quarter, given the lead that some of the construction data has on starts, right? I would expect that completions number to fall further this year, especially given some of the financing challenges on the multifamily side right now. The good news is that that's strong for rents, right? We do see apartment leasing that's still strong as starts are falling nationwide. That is the apartment absorption ratio, or absorption to start ratio. And the good news, I think, from our perspective, is that strong demand and falling construction is likely to support some of that rent growth in the near term. As long as household formation remains strong, that lack of construction, I think, is going to support that rent growth. That being said, I do always think, we're always cognizant of making sure that our clients are aware of any potential headwinds to apartments. And so I want to run through just two I'm thinking about right now. One is the immigration component, right? There's a potential drop in immigration this year, given some of the proxy data that we're already looking at, given some of the messaging coming out of the administration. We're expecting to see a drop in immigration this year. We're already starting to see a drop in immigrant visas issued. Not impactful in every market, but definitely outsized impact in some of these coastal gateway markets, potentially in university markets as well, as they talk about rolling back some student visas. Just a headwind to potentially be aware of on the multifamily side. The other component, this is a little bit less of a direct competitor with apartments, but we do look at the single family rental side very closely. And one thing that we're seeing also on the for sale side is we're seeing resale inventory start to climb. So we've got a lot of new homes under construction, and we're also seeing more sellers on the resale side continuing to list their homes. That's pushed affordability up to levels that we haven't seen in a couple of years. And what's happening as a result of that is that some portion of that resale supply, of that new home supply, is coming onto the rental market. So again, not quite a direct competitor with apartments, different floor plans, different buyer profiles a lot of the time, but still adding to rental stock, to rental housing stock in a lot of these markets. And you can see that as inventory has risen, you've started to see single family rental occupancy fall gradually over time here. That's going to put downward pressure on rents, I think. So there's another potential headwind to be aware of here. That's all I had on the analysis side. I do really quickly want to plug an event that we have, an opportunity that hopefully you can take advantage of. I mentioned a little bit earlier some of the events that we do that are typically client exclusive. We have one that's open to a couple prospective clients if you have any interest. We have a rental community summit. This is a virtual event. We have a great lineup of speakers from everybody who's anybody in the rental community space. So again, that's apartments, and that's also dedicated build to rent communities as well. That's going to be on July 22nd, 2025. And again, a virtual event. Feel free to reach out to us, client services at jbrack.com, or you can reach out to myself. We're happy to see if we can get you signed up for that event. Should be a really good time for anybody who's interested in the rental side of things. Just a couple key takeaways here just to wrap up. CRE investors are still in wait and see mode. We've got elevated rates, elevated uncertainty, and in our view, things are likely to stay that way through the balance of the year, unless we start to see rates to fall significantly, but doesn't seem likely at the moment. There's still some pretty significant policy headwinds, I think, right now. We see changes in trade policy and immigration trends presenting risks to certain sectors, right? So on the retail side, you've got headwinds to brick and mortar stores, to consumer spending, to supply chains. On the industrial side, we're not expecting to see any major benefits over the near term here, any benefits to reshoring, to investments in manufacturing, probably more of a longer term story. And then in office and multifamily, as I mentioned, some outsized impact in gateway and immigration heavy markets from a lack of foreign immigration and potentially a lack of foreign capital interest as well. That being said, I do think there's opportunities. I want to end on a good note here. I do think that, as I mentioned, for multifamily, you see that poor for sale affordability really supporting healthy demand for multifamily right now, especially as completions come down. I think that puts positive upward growth on rents. You also see a flight to quality in Class A for office, right? So there's still opportunities within office, even given some of the structural headwinds of the sector. And then also, I think as we start to see more things come to market here, there's going to be more opportunities for distressed opportunities, right? And I think, tying into that kind of fear and greed mantra we've got for our survey, I always think about that Warren Buffett quote, to be greedy when others are fearful, right? I think you're going to start to see some opportunities for some opportunistic acquisitions going forward here. It just takes a trained eye and the most information that you have at your disposal to really make the best use of the information that you have and look for those good opportunities. With that, I'll just some quick resources for everybody. How can I access the full survey results? They are available both on the CRE Daily website and on the John Burns website. The links are here. You can download the full survey results straight to your inbox. If you want to get the surveys in the future sent directly to your inbox without having to go to the website every single quarter, you can sign up for either, or I'd recommend both, the JBREC and the CRE Daily newsletters. The newsletter on the CRE Daily side is great insight for anybody on the commercial real estate side of things, CRE news and insights every single day. The John Burns newsletter also, we focus a little bit more on the residential, but also on the commercial side of things. We do some great analysis that should be delivered to your inbox between 1 and 3 times a week. And included in that will be the full download link to the CRE Daily and John Burns Fear and Greed survey. And lastly, if you're sitting back there and you're wondering, okay, I wish I could participate in this survey, please sign up for CRE Daily's newsletter. Every single CRE Daily subscriber gets a personalized survey link sent to their inbox every single quarter. So you can participate in the survey and help us get the most high quality data that we can and really paint the best picture of the market that we're able to. You also get a chance at a prize as well. With that, I'm going to go ahead and stop and open it up to, I think, some Q&A. I'll check the chat here to see if any questions have come through. But I'll stick around for just a moment. Feel free to put some questions in the chat, and I'll try and answer them as best as I can here. All right, I'm not seeing anything here. Well, thank you guys all for attending. If you do have questions, feel free to reach out. My contact information is all there. athomas@jbrec.com. You can also follow me and a lot of our different John Burns people over on Twitter, on X, and on LinkedIn as well. Feel free to look for us. We're always posting a lot of great stuff publicly. So feel free to reach out. Thanks, everyone.